Hello and welcome to our monthly webinar from the University of Iowa's Tippy College of Business. Today's topic, debt, rates, and tariffs. What's really driving the U.S. economy? I'm Nick Westergaard. I teach at Tippy, where I lead our Story Lab program and host the Tippy Leads podcast. I'm excited to be with you here today. But before we jump into the main topic, I'd like to highlight our next webinar, Prompt Power, how to use AI to supercharge your job search. This interactive session will provide a hands-on look at how to use AI tools like ChatGPT to enhance every stage of your job search, from resumes and cover letters to interview prep and company research. Join us at noon on Tuesday, August 19th. I'll drop the registration link for that future webinar into the chat shortly. Speaking of future webinars, if you have a topic you'd like to see covered from our faculty experts here at Tippy, feel free to add that to the chat as well. Another item to note is that today's session is being recorded and will be available on Tippy's alumni and lifelong learning web pages, as well as our YouTube channel. Past webinar recordings are also available there, all of which are free and open to the public. So feel free to share this information with others. Now, let's dive into today's topic, debt, rates, and tariffs. What's really driving the U.S. economy? Our featured speaker today is Professor Anne Villamil, Henry B. Tippy Research Fellow in Economics and Professor at the Tippy College of Business. An expert in macroeconomics, she'll be helping us make sense of the big picture forces shaping the U.S. economy, including interest rates, inflation, federal debt and deficits, and global trade. Anne will break down what matters most right now and what we should be paying attention to as we look ahead. Whether you're tuning in as a business leader, investor, or just trying to get a better handle on the economic landscape, I know you're going to leave with tools, insights, and a deeper understanding to help you navigate today's economy with confidence. We'll have plenty of time for questions at the end of our discussion. Please use the Q&A button at the bottom of your screen to submit your questions, and feel free to use the chat to communicate it with us. Now, with that said, let's get started. Take it away, Anne.
Thank you, Nick, and welcome everyone. I too am very excited here. These are very important, high-stakes issues, and I'm looking forward to this discussion. So in terms of the overview of our talk this afternoon, we're going to talk about the state of the U.S. economy. We're going to talk about three macroeconomic key performance indicators: GDP, employment, and inflation. We're going to talk about three important macroeconomic policies: fiscal policy, monetary policy, and trade policy, all of which are very active right now. We're going to talk about data coming in during this pivotal week. This is a word that's been used precisely because four things are happening this week. We're getting new data on those three key performance indicators. GDP reading comes out tomorrow. Inflation reading comes out on Thursday, and in particular, the Fed's preferred measure. And the employment come out on Friday. The Fed, in its Federal Open Market Committee meeting, is meeting today and tomorrow and will put out a statement. So that's key. Trade agreements seem to be coming out. Many are supposed to come by August 1st, so we'll see. And then there are some key earnings announcements going on with markets. So as Nick said, one of the things we want to talk about is what are key economic forces that are driving the economy. Let's begin with our three key performance indicators. The first is GDP. And GDP is a measure of the goods and services in an economy, really the size of economic pie. And this graph shows us the growth rate of real gross domestic product, which again is how the economic pie is growing over time. On an annual basis, the U.S. economy tends to grow between 2 and 3%. However, we see in this graph that there are white periods and gray periods. The white periods are economic expansions when the economy is largely growing, and the gray periods are periods of contractions or recessions. And so literally, this is quarterly data on the growth of gross domestic product. And so you can see in the first quarter of 2025, we actually had a slightly negative reading. GDP declined by 0.5%. We are not in a recession. And one of the reasons last quarter we had negative GDP growth, that is a decline in GDP, is that we've had a lot of things going on, as you know, with trade policy, tariffs announced, and many individuals and firms were trying to beat the tariffs by increasing imports, which caused total GDP to decline. GDP, as I said, is the value of all goods and services, but it's consumption by individuals, investment by individuals and firms, government spending, and then something known as net exports, the difference between exports and imports. And again, tariffs are effectively a tax. When the administration announced that taxes on imports would go up, rationally, many individuals and firms tried to beat that price increase by importing more now. Okay. So the growth rate of GDP is measured on a yearly basis and updated quarterly. This is real GDP, so it means it's adjusted for inflation. And again, we are going to have new data tomorrow. That is going to be an important number. And the economic situation we're in right now is sometimes referred to as a Goldilocks scenario, in the sense that we don't want growth to be too high. If it were too high, we would worry more about inflation. We don't want growth to be too low because we don't want that economic pie to be shrinking. We want it to be just right? And we will see what the numbers are tomorrow. Our second key performance indicator is unemployment. And this is employment going back to the 60s. Again, you can see periods of white, which are periods of economic expansion. And you can see periods of gray, which are periods of recessions. And so you can see that the unemployment rate has what economists call strong cyclical components. And what that means is, let's look at the 2008 recession, which was long and severe, the one associated with the financial crisis. You can see that during that recession, and really all recessions, unemployment rises. And in the 2008 recession, it rose to about 10%. This 2020 recession is, of course, the COVID recession. You can see that unemployment rose to 15%, which is, of course, very high. But the good news is that that recession was very brief, and unemployment came down quickly and is now about 4.1%. Again, the new on Friday is coming. So you can see that recessions occur irregularly, and they are different in the sense that some last a long time, 18 months. During COVID, it was very, very short. Some are associated with quick recoveries, which was the case during COVID because we had substantial economic policy, and some are associated with very slow recoveries, which happened after the financial crisis. Our third key performance indicator is inflation. There are three main measures of inflation. I'm going to focus on the Fed's preferred measure, which is the personal consumption expenditure index. And you can see that, so again, this is the COVID recession, and inflation was low until it jumped up by the PCE measure to nearly 7%. It has come down quickly, and that is certainly good news. It's coming down further. It's less than 2.5%, but we can see a fair amount of variability. And I want to say just a couple of words about inflation in the 70s and the 80s. In the 1970s, this is about 1979, we had high inflation. Even by this PCE measure, it was well above 10%. It had two peaks, and high inflation was associated with a recession in the late 70s, and then back-to-back recessions in the 80s. And I point this out because this is something that is in the Fed's mind, right? So high inflation, recessions, something often referred to as stagflation, and I will come back to that. We are not in that situation now. The GDP, I'm sure the number this week is going to be positive. So the economy is growing and inflation is coming down. And that is a good situation to be in. Okay. So those are our key performance indicators in terms of the big three macro measures. Let's talk about the debt and the deficit and fiscal policy. The federal deficit is on an unsustainable path. This is federal debt from 1790 through the Civil War, World War I, the Great Depression, World War II, the Great Recession, which was that period in 2008 when we had a financial crisis, and you can see debt increasing, the pandemic. And this is where this dotted line is where we are now. And the debt to the right of the dotted line, those are projections for where we may be in the future. And you can see the projections indicate that federal debt is expected to increase. This does not to occur, but if we did not change our policies, this is what our path look like. So as you can see, our current debt is similar to when we were in World War II. After World War II, the debt declined, okay, until we had other economic shocks that caused it to change. Now, when you look very briefly at this, one takeaway is that wars are not good for economic health. You can see the Civil War, debt went up. World War II, debt went up. World War I and debt went up. World War II, debt went up. Okay. And so this is where we are today. Related to the is something known as the deficit. And the deficit is very simple, but very difficult. And it's related to basic algebra. And those are always the difficult idea. So what the debt is the difference between taxes, that is revenues that are flowing into the government, and government expenditures. If taxes are bigger than expenditures, then we have an economic surplus. And if taxes are below government expenditures, then we have a negative number, and that is a deficit. So let me just walk you through. This is 1990. This is average spending, the red line. In other words, the level of government spending from 1990 to present and projections for further spending. The blue line are average revenues. So this is what government takes in taxes. And you can see that that fluctuates, okay? And maybe was scheduled to increase a little bit, but we've recent policy change where we've cut taxes, which is going to lower revenues. And so I want to point out a few things about this graph, and this is actual data for the US economy. Spending fluctuates, revenues fluctuate a bit, and one of the most important things is that there is a persistent gap between what we are spending and what we are taking in. And that is creating what is called a structural budget deficit. In other words, we are just consistently spending more than we're taking in. Now, that has not always been the case. And this is, 1990 to 2024. When revenues are above expenditures, that is when we have a budget surplus. And that happened in 2001, right? So we actually had a budget surplus, which meant we were taking in more in revenues than we were spending. And so that was under the George W. Bush administration that occurred because we had raised taxes and we were cutting expenditures. So the US implemented a tax cut. Unfortunately, very unfortunately, in 2001, that was the 9/11 situation. So we ended up with a recession, and during recessions, tax revenues tend to go down. Why? Because people lose their jobs. So this is the 2001 recession. This is the 2008 financial crisis, and you can clearly see tax revenues going down. This is the pandemic. Interestingly, revenues didn't go down as much as they typically do, but that is because, as you will recall, there was a lot of stimulus in the US economy during the pandemic. Okay. And so during these business cycle effects, revenues tend to go down during a recession and expenditures tend to go up. Why do expenditures go up during recessions? Unemployment, insurance, things of that nature. And these are often referred to by economists as cyclical budget deficits. In other words, we have a recession, tax revenues go down, government spend up, but these are largely viewed as self-correcting in the sense that as we work through that recession, we get back to sort of, a normal, these lines being closer to each other. So those are cyclical deficits. Structural deficits, again, are the difference between those two lines and that fundamental imbalance in the economy. Let me say a few words about so fiscal policy is basically setting the level of taxes and government expenditures, which is decided by the president and Congress working together. Okay. So that's fiscal policy, and it has effects for the level of the deficit and also the outstanding debt. Because the one piece to connect is when we have a deficit at the end of the year, what do? We issue debt. Okay? And so fiscal policy, the level of deficit and debt are all connected. So that's our first economic policy. Let's talk about our second economic policy, trade policy. So technically, trade policy is the domain of Congress, but Congress has delegated a lot of the authority to the president because often we need to either act quickly or have protracted negotiations that it would be Congress eventually ratifies trade agreements, but it would be very difficult for 535 members of the two houses to get involved in these negotiations. So trade policy is broad, but something that has been going on very recently, as you know, are changes in tariffs. What is a tariff? A tariff is a tax on imports. Okay. And so this goes back to 1927, and you can see that tariffs in the 1930s were nearly 20%. And then there was a concerted effort to reduce tariffs. And recently, tariffs have been well into single digits, except for very recently, Trump has indicated multiple times that he wants higher tariffs. Okay, so these are just what the rates are, and I'm sure you saw this morning that there have been announcements that the U.S. and the EU, which is a very important trading bloc, have reached an agreement that tariffs be 15%. I want to point out that even 15% significantly higher than where tariffs were. Okay? And so tariffs currently, though there's a bit of uncertainty about where things are, because there have been many announcements that tariffs are going to be very high numbers and then the dates are pushed back. But tariffs, the direction of tariffs is certainly up. And there is a lot of uncertainty about tariff policy. So I'll probably come back to that. That is not helpful for the economy. And the last thing, or the last main policy, is monetary policy. Monetary policy is set by the Fed. As I said at the outset, the Fed, as we speak, is having a Federal Open Market Committee meeting. Those are two-day meetings that occur every 6 weeks. And at those meetings, the Fed, among other things, chooses a policy rate. And most importantly, tomorrow, when Chairman Powell makes a decision or announces the decision made by the Federal Open Market Committee, announces the state of the economy and gives future guidance. So the Fed sets what's known as the federal funds rate. And you can see this is the federal funds rate. Okay. And prior to the global financial crisis, the federal funds rate was maybe 4 3/4. Was 5. And then we had a quite severe recession during the global financial crisis around 2008. And you can see the Fed dropping its policy rate, the federal funds rate, to effectively zero from 2009 to 2016. So many people have a sense that interest rates are low and should be quite low. This was a very significant policy crisis. As the U.S. started coming out of that policy crisis, the Fed started increasing the federal funds rate. And you can see during the COVID recession, right? You could see during the COVID recession that Fed very quickly lowered the federal funds rate to zero. Then we saw inflation. So the Fed increased the federal funds rate very quickly and significantly. And so this is part of the target range. It had started decreasing the federal funds rate, and now the Fed is on pause. So we'll come back to that. These are just facts in terms of where we are. What the Fed usually does is, if the economy is expanding rapidly and there is risk of inflation, the Fed tends to increase the rate or keep the rate high. And if the economy is in a recession or growing slowly and there is employment risk, then the Fed tends to lower that rate. So the US Federal Reserve has what's called a dual mandate, which is set by Congress. And the Fed operates independently, but it is given its charge by Congress. This is in a piece of legislation known as the Humphrey-Auckland Act, and it tells the Fed to essentially pay attention to both inflation. We want a stable price level, and we want full employment. And sometimes those goals conflict. Okay? So this is what the Fed has been doing. These are their marching orders, so to speak, to take account of inflation, stable prices, and full employment. The two other series are 10 and 30-year treasuries. So these are interest rates that are not set by the Fed. They're effectively set by markets. So the green line is year treasuries, and the red line are 30-year treasuries. Okay? And again, they are set by markets. And what you can see recently is those rates, particularly the 30-year rates, the long rates, have been trending up. And that is because when we talk about markets, we're talking about people buying or 30-year treasuries. And so people who are buying treasuries take into account monetary policy itself, fiscal policy, which has been quite expansionary recently in terms of cutting interest rates and in terms of cutting interest rates. So monetary policy, fiscal policy, and trade policy, where we have been increasing interest rates significantly, increasing tariff rates significantly, excuse me. Okay, and the Fed's rates influence other rates like mortgages, loans, and savings, but it's more complicated than that, right? The Fed does not simply get to pick the interest economy in the US or the world, although it does have influence over short-term rates, less so over long-term rates. So the big picture here is right now, it is a fact that interest rates are high, and there is a policy conflict. And it is particularly interesting that we are in this conversation today as the Fed meets. The administration has said very clearly and repeatedly that the Fed should cut interest rates by 3 points. And it is said that high interest rates are costly, and they are, and that the American economy is hot. And the GDP numbers and employment numbers are coming out this week. GDP tomorrow, unemployment numbers on Friday. Now, there's a bit of a disconnect here between the administration's view of this and I think the Fed's of most economists. When an economy is running hot, that's actually not the time you want to stimulate it. Okay. You want to, particularly if you have a big budget deficit, that would typically be the time when, in terms of, you would have a slower fiscal policy. So that would typically involve, if you have a big deficit and outstanding debt, increasing taxes, not a decline. And you would not expect the Fed to be cutting rates. What's the Fed's position on this? The Fed's position is that we need more information. We want to see these numbers. The Fed has said GDP is in pretty good situation. That's good news. Inflation is coming down. It's approaching the Fed's 2% target. The Fed has said that they're essentially there on inflation. We're concerned about what's coming next. And what are they concerned about? What do they mean by this? They're concerned that this very stimulative fiscal policy could reignite inflation, and they are concerned that the tariffs could reignite inflation. And they're concerned about something known as stagflation. And I showed you this long period with two peaks in the 70s and 80s of inflation. So in the 70s and the 80s, we also had big budget deficits and we had inflation. So that's the inflation part of it. And we had very slow growth, and indeed in the 80s, back-to-back recessions. So stagflation is something, so it's low growth or recession and high inflation that no one wants to see. Okay? The 80s, a difficult period. Interest rates were high, inflation was high, unemployment was high, and that's a place that we do not want to return to. Okay? So the Fed repeatedly says that it wants expectations well anchored at 2% to what is known as a wage price spiral. What is a wage price spiral? If people come to believe that inflation is going to go up, then they are going to ask their employers, give me a raise, keep me whole. Their employers may say, sure, I'll give you a raise and I will pass that increase in my costs as an employer onto the prices of my product. And that will feed into higher inflation. So it would be an upward spiral, right? That I, as an individual, am consuming, am experiencing inflation. I demand higher wages. My employer may say, sure, I'm going to pass it on to consumers. And we end up going up and up and up. And that would not be a good state of affairs. So the Fed very consistently says, we want expectations to be well anchored at 2% so we don't end up with this wage price. Okay. So are rates too high? So there's been average spending on research and development, infrastructure, education. Used other examples, but these three categories have been 2.4% of federal spending as a percentage of GDP on R&D, infrastructure, and education. The interest costs in 2024 exceeded what we spent on R&D, infrastructure, and education. Okay, so that's not great. It would be great if instead of paying interest, we could use those funds either to cut taxes or engage in other types of spending that we think are useful. Okay. These are projections of the interest costs in 2034, that they're going to rise at 4%. 2024 and 2054, these are a long time out. But the takeaway from this graph is that if we do nothing, interest expenses are going to increase. Okay? And so this has led administration to say, well, let's just cut interest rates. Okay? So why aren't we doing it? Again, the Fed is concerned that if we simply cut interest rates and stimulate the economy, we are going to have more inflation. And that, in combination with tariffs, it could slow growth. And that would be very detrimental for the economy. So this is something about alternative ways to think about setting monetary policy. But the takeaway from this graph is that this purple line is the actual Fed's policy rate. And on alternative policy rules that the Fed could use to set monetary policy rate, we seem to be doing about right. So, final thought in terms of the long term, and that's something I would really encourage all of us to think about. We are having an expansionary fiscal policy. The US has just passed the Big Beautiful Bill. And expansionary fiscal policies tend to raise interest rates. Okay? This is something that's kind of well agreed on economics. Furthermore, when the economy is doing well, that's usually the time that we increase taxes a bit, right? Or cut expenditure, not cut them. So what are the potential implications of an expansionary fiscal policy? These are numbers from Ernst & Young, but we could use from the Congressional Budget Office, Bloomberg, lots of individual economists. GDP tends to fall when interest rates are high. There are concerns about unemployment rising. So this is jobs declining. So unemployment declining. There are concerns about private investment being, economists call it, crowded out by high interest rates. And these are predictions on decreases in wages. So these high interest rates are concerning for the economy. I talked about this before. Let me go one slide. We are having an aggressive trade policy, again, going back to the 30s, where we had our last trade war associated with the Smoot-Hawley Act, a policy-induced trade war. And these are projections of or announced Trump tariffs. And it does seem the recent statements from the administration is that for a lot of countries, we are going to settle around 15%, but that is still much higher than tariffs were. And why are economists concerned about that? Well, when we raise tariffs, it tends to lower growth, shrink that economic pie, or at least lower the rate of growth. It can raise prices. That's known as pass-through. Remember, a tariff is a tax. So if the United States imposes a tariff, a higher tax on imports from another country, those producers from foreign countries may increase their price to those in the US. That's one point it can occur. And when firms are faced with higher taxes, tariffs. They may increase those prices to consumers or other firms who are buying their products, right? So the degree to which that occurs is called pass-through, and that can be inflationary. And that's a key reason why the Fed is saying, let's wait a bit before we do anything and see what's happening in the economy. Okay? And then the final point I want to leave you with is economic growth. Economic growth of GDP, that pie, is essential. It directly affects our standard of living. Of course, there are differences with regard to inequality, but in general, a bigger economic pie is a good thing. Inequality is related to who gets which slice of the pie, but a bigger economic pie is a good thing. And it makes the outstanding debt and deficit easier to manage and ultimately run down if we have a growth economy. What do we know about growth? We know a lot about growth, actually. It requires more capital in the economy, so investment. It requires the right amount and appropriately trained labor in the economy. And it requires technological progress. The US actually tends to be amazing on the technological progress part of it. There are concerns about capital. We need investment, and there are actually, particularly in some sectors, concerns about labor. So I'm going to leave it at that. Whoops. And thank you, and I look forward to some questions.
Awesome. Thank you, Anne. That was a fantastic overview and helped connect the dots on a lot of complex issues. We've had some questions submitted ahead of time. We've also got several that have come in via the Q&A feature right here on Zoom. It can be kind of tricky to find, but it is that little word bubble with the question mark in it if you want to submit some questions. But I've taken a stab at categorizing some of these, and as expected, we have some on debt, tariffs, and interest rates. So, Samuel asks, what are policy changes the U.S. needs to make to decrease the federal debt? Which ones would have the greatest impact?
Okay, so that's a good question. Remember, the debt is just the accumulated deficit. And the deficit is the difference between tax that we're taking in and government expenditures. And we often talk about that in of the debt or the deficit per capita. And that means we take into account the GDP. So that means if you want to get your deficit under control, and you want to run down your debt, which historically we have done. I've shown you that. So we know how to do this. It's not a question of knowing to, it's that it is hard to do it. There are three alternatives. The first is to raise taxes, and no one likes to raise taxes. The second is to cut expenditures, and it is common to say, yeah, cut expenditures, but not mine. And the third is to keep the economy growing. So we're going to see, because we've done really a very major policy change with the big, beautiful bill. We have cut taxes. We are cutting expenditures, but those are loaded a few years out. And again, we're going to have a new number tomorrow. GDP is okay at the moment.
Follow-up question on debt as well. Rebecca asks, to whom does the U.S. owe this money? Who is loaning our government money? Who is profiting from the interest charged? I've never understood that part. Second, how do you view job loss due to AI development in regards of consumer spending and recession proofing?
Okay, wait a minute.
It's a big one.
So, yeah,
The first part is is who's loaning us money? Who do we owe debt to?
So in terms of the outstanding debt, I must distinguish between two things. One is we owe it to ourselves, and the other is that we owe it to others. So about two-thirds of U.S. debt is held internally, so we owe it to ourselves. And so obviously people care about who gets those payments, but to ourselves. The one-third component is debt that is held externally, and those are in payments that are held abroad. The U.S. is what's known as a reserve currency. It really underlies the world financial system. And so other banks, other governments, other individuals around the world hold U.S. debt. And that is important because if the demand for U.S. debt is robust, then we can place that debt more cheaply than other countries can. Right? And it's sometimes been referred to as U.S. exceptionalism. And why have we been able to do that? Because we have always been good stewards. And the belief is that the U.S. will be the last standing, right? Lots of bad things could happen, but the U.S. has a strong economy. It has very deep capital markets, and maybe with the usual political difficulty, eventually we will get it right. Right. So that's the answer to your first question. Your second question was about job losses. And Nick, you want to follow up with that a bit, clarify
Yeah,
that
it
again?
was. Yeah, it was. How do you view job loss due to AI development in regards to consumer spending and recession proofing?
Okay, I love that question. We've just developed a new course on that where we're talking about some things. And the honest answer to that question is we don't know yet because it's too new. This may be revolutionary, and we may have some job losses. I mean, surely we'll have job losses, but the question is not, do we lose jobs? It's, do you find a better job? Because this is the nature of technological progress. As I said, the US is terrific at technological progress, but we've been dealing with this really since the beginning of time. During the Industrial Revolution, there were lots of new machines being built, and the Luddites were worried that, oh, we have all these new machines being built and we're going to lose a lot of jobs. Did we lose jobs? Yes, we did. We lost certain types of jobs, but we developed other jobs, right? So machines replaced some labor, but then we needed more people to fix machines and design machines and come up with new ideas. So that's the tricky part, and that's why we don't know yet. But it is absolutely a very valid concern.
So let's jump over to or back to tariffs. Laura asks, what's the rationale for implementing tariffs?
So also good question. Uh, One rationale for tariffs is that it is just a negotiating tactic, that we want to, in a negotiation, threaten other countries and get them to give us better access to their markets. Uh, and so we are going to get them to open their markets by saying, if you don't do this, we are going to place these very, very high tariffs. And, we know we are shooting ourselves in the, but we can withstand more pain than you can. Right? A second is that we want to use tariffs to raise revenue. Tariffs are really not a particularly an efficient tax. And yeah, other than there are some other, but I think those are the main views that what we're really trying to do here is influence other countries to open. Let me say that that's a legitimate concern, but this has been going on for a long time with a lot of uncertainty. That's what the Fed is worried about.
So Stephen has the logical follow-up question of what is the likelihood that these tariffs achieve the positive intended consequences that the administration says they'll have?
So it is very hard to answer that question. Remember, this first started in February, and then we had an April date, and we had a bunch of interim dates, but the third big date was August 1st, that we were supposed to have 90 trade agreements done, and we don't. And even the trade agreements that we have not been largely written down. And so this continues to add to the uncertainty. And let me say, so the United States has what's called a U.S. Trade Representative's Office. It's part of the executive office, and this is the entity in the government that typically negotiates all the bilateral trade agreements. In the past, I've worked for these guys for a year, so I know how they operate. These are very, very complicated agreements. Countries routinely say they're going to do things and then they don't do them. So you have to have lots of clauses and mechanisms to get this fixed. And it is very a complicated business. We're not using USTR right now. And so I think that there are concerns about certainly getting these trade agreements done. So the EU just today said, look, we've agreed to basically 15%, but there are so many details around that as with Japan recently, we don't really know what that agreement means.
On the subject of rates, Joe has a follow-up on the administration's positions that the economy's hot. So why the drastic cut in short-term interest rates? Why aren't they concerned about inflationary effects?
Yes, I don't know. Honestly, the answer to that, and that is really the source of the disagreement between the Fed and the administration. Certainly understand, and it's just clear from the data that high interest rates are costly. But the Fed is very, very concerned about that stagflation that occurred in the 80s and was very, very painful. And that is why the Fed is both saying we want to see more data, and it is at every turn saying we want inflation expectations to be well anchored. Because if the US were perceived as what's referred to as monetizing those deficits, those long-term interest rates on 30-year bonds would go up, not down, even though the Fed was lowering that policy rate. That's why I showed you that slide. That is something that's very, very important. Central bank credibility and independence is very important.
So Scott asks, do you believe that the Fed will lower interest rates this week? Why or why not?
Yes, I don't believe that the Fed will lower interest rates this week. I think the Fed is going to keep interest rates where they are. The interesting part of the FOMC's announcement tomorrow is going to be what it sees going. I think markets and the expectation and hope is that there are 2 declines by the end of the year. But I fully expect the Fed to say that we are going to continue to watch the data and make decisions as appropriate. What we may see is 18 people vote on the FOMC what to do with interest rates. Usually those votes are unanimous. We may see 2 of the Fed peel off and express concerns. And there are concerns. The Fed has a dual mandate. We want inflation to be 2%, but the Fed is concerned about the labor market. One of the governors, Chris Waller, is a very serious guy, has said, I'm concerned about the labor market. And so a case could be made. So it's going to be up to them. They will put out a statement tomorrow on this. But that is the nature of the dual mandate. They have said that the two objectives are kind of similar, and we want to wait and see more data. I absolutely do not expect a decline in interest rates tomorrow.
So you did such a great job of looking at a lot of this over time. Dennis asks, how many years will it take to see the effect of higher tariffs on GDP and growth?
Yeah, that's a great question. Again, that's it to pass through, and this is a very complex issue. So there are two close cases. One is the Trump administration one. Under Trump administration one, we did in tariffs on selected products, and we did see the prices of goods go up. So one example was washing machines, right? That we to protect the industry, we raised tariffs. And interestingly, we did not raise prices on dryers, but they're what economists call a complementary. And even though we didn't raise tariffs on dryers, prices went up. So we know that firms pass through. The big question is how much. So that's one case. The other question is actually Brexit. Brexit left the European Union and effectively ended up with higher tariffs. And that was a slow moving thing, right? So the vote occurred in 2016. The implementation didn't start until 2021. This was actually during the pandemic. And so it really took a long time for this to happen. I would expect that the president, I certainly can't speak for him or his administration, but I don't think he really wants to have these high tariffs. I'm not really sure. But introducing this uncertainty is hard because we know when we raise tariffs, we risk shrinking GDP. It's not been good for the UK economy, and we risk inflation. So the time frame, it's very hard to say. Because, by the way, remember my chart? The last time we had a trade war was roughly 1930. This is not something we want to have, right? It really is economies and relationships.
So I want to close with a note from the Q&A from Natalie, who says, I don't have a question, but more of a statement. Thank you for this webinar. I appreciate your clear and precise definitions, explanations in an area that can get muddled. And I share that same sentiment. So, Anne, big thanks for being with us here today.
Well,
Just a
thank you to all of you. Yeah.
Just a reminder to our viewers, this webinar has been recorded and will be available on the Tippie College alumni resources and lifelong learning pages, as well as our YouTube channel. Right after the webinar, a brief survey will appear in your browser. Please take a moment to share your feedback to help us enhance our future webinars and lifelong learning programming. Speaking of which, don't forget to sign up for next month's webinar, Prompt Power, how to use AI to supercharge your job search, a practical session on using tools like ChatGPT to stand out in every stage of the process. That's coming up on Tuesday, August 19th at noon. The sign-up link should be there in the chat. On behalf of everyone at Tippie, thanks for listening and go Hawks.